What is going on? Welcome back to Learn About Bit. In this video today, we are talking national debt because our national debt is getting to absurdly high levels. The United States is nearing $36 trillion in national debt. Unless you're living under a rock, you know that we have a big presidential election coming up tomorrow. And one of the main things that I've been seeing people debate on is which candidate is going to be better for inflation. People are looking at Trump's prior term and they're looking at this current and soon ending term for the Biden and Harris administration, and they're comparing the numbers. But I think it's important we take a look at the real elephant in the room, the real reason why inflation continues to grow. That is the national debt and our federal budget deficits that continue to grow larger. So that's what we're going to be talking about in the video. Before I get into it, please make sure to like the video and subscribe to the YouTube. Really appreciate your support. The United States is nearing $36 trillion in debt, and we're currently running over a $2 trillion deficit. And if you actually go to debtclock.org, they have this cool feature called the Debt Clock Time Machine, and you could see what the projected national debt and budget deficit are going to be in 2028. It's 51 trillion for the national debt, and we're projected to run a $4.3 trillion deficit. So that's a lot of growth in the national debt over the next 3 to 4 years, from 36 trillion to 51 trillion. And I think it could even be higher with all the economic issues that the country is going to run into. But why does the national debt lead to inflation? Let's get into that. The United States is in a debt spiral. And basically what this is let's say there was a person and they took out a loan and they couldn't pay back that loan, so they had to take out another loan to pay off that first loan, but then they couldn't pay off the second loan, so they had to take out another loan to pay off that, and so on until their debt just grew to an astronomical number. That is the situation that the US government is in. Now, thankfully for the US government, they have a money printer, the Federal Reserve, who can create currency units out of thin air. If you or I were to go into a certain amount of debt, we would get to a point where no lender is going to loan us any more money because clearly we're not going to pay it back. Let's say I was $36 million in debt and I work at Foot Locker and I come to you and I say, hey, can you loan me $2 million? You're probably not going to loan me the money. Or if you do, it's going to be at a crazy high interest rate to account for that risk. Most likely, you're just not going to loan me the money. But because the federal government has the Federal Reserve who can create this money out of thin air, they can basically borrow the money from the Fed in an indirect way. And we're going to get into how they do that. Now, looking at the current fiscal situation of the United States, where we're running over a $2 trillion deficit, that's a lot of money, right? When the United States runs a $2 trillion deficit, that means that they have to go find $2 trillion in the economy to fund that overspending. That's a lot of money to just find lying around. Most people don't have a ton of money to invest in government debt. And in a period like we're in now, where the economy is contracting, it's harder and harder to find that money. And basically, when there aren't enough people who are willing to buy the government's debt, we see treasury yields rise. So that interest that lenders are paid for lending money to the government, because if nobody's willing to lend the government money at a 3% interest rate, then that interest rate has to rise to incentivize people to lend the government the money. But at the same time, as these treasury yields rise, this is bad for the government because that means that they're going to have to pay a higher amount of debt back in the future. If somebody buys a treasury bond that's yielding, let's say, 6-7% over 20 years, that's a lot of money that the government is going to have to pay back at a future point in time. So the government does not want treasury yields to rise too much. That is not good for them. That means that the national debt is going to grow faster and faster if yields continue to rise. So let's say there's not a ton of demand out there in the economy for treasuries. And I think with this large amount of national debt that we have, people are starting to clue into, hey, where does this end? Where is this going? Where are we going to be with the national debt in a couple of years? We can think about it like that example that I just told you. You're not going to lend me money if I'm $36 million in debt. Why are people going to continue to lend the government money if they go into higher and higher amounts of debt? But let's say there isn't a lot of demand and treasury yields are rising. Well, here's where the Federal Reserve comes into play. The Federal Reserve will basically create new monetary units. They call them reserves, and they will exchange those new monetary units for treasuries in the economy. So basically, when they do this, they're pushing new money out into the economy, and they're taking treasuries out of the economy and holding those. So this is how the national debt leads to the money supply increasing. As the United States goes into larger amounts of debt and larger deficits, and they're extracting money out of the economy, the Fed basically has to push new money into the economy or things start to fall apart. So what's really happening in simple terms is the Fed is creating new money and the Treasury Department is creating new treasuries. And the combination of these two things is what leads to a higher money supply. The Treasury has Treasury auctions where the financial institutions like the banks buy these treasuries, and then those treasuries are exchanged and bought indirectly from the Fed. The new money is pushed out into the economy, and because of that, we get inflation. Now, you might be thinking, why does the Fed need to do that, right? If that's what's creating inflation, the Fed pumping the money out into the economy and exchanging it for treasuries, why don't they just not do that? Why can't we just let treasury yields rise and have the Fed not intervene like this? Well, let's say that we don't create new money and push it out into the economy, and the US government has to continually take more money out of the economy, right? As the debt continues to grow, as yields rise, and each new round of debt that they have to pay off is larger, they're basically just extracting wealth and resources from the economy. This money that goes to buy treasuries, that's money that could have been used to build out a farm or build a home for a family or start a business. It could have been used in some other productive way. So really what national debt does when it grows too large is it really starts to rob the economy, is more resources have to be used to pay off the government's expenses. And really, when we think about the interest on debt expense, this is not a productive expense for the government when they have to spend $1 trillion on this every year. That doesn't help our infrastructure get better. That doesn't help our children get smarter. It doesn't help us build in society. So this is part of the reason why we see more homeless people out on the streets. Really, it's the main reason. It's a reason why we have inflation. It's a reason why people are starting to find it harder to get by, because the government debt is robbing the economy of money that could be used for other productive purposes. As this money is extracted and it's not being used for productive purposes, we see the economy start to contract. It gets a lot harder for businesses out there and individuals. And in this credit-based system that we have, the economy does not do well when it contracts because we really take out loans for everything in the United States. You want to buy a home? you take out a loan. You want to buy a car, you take out a loan. You want to send your kid to college, you take out a loan. You want to start a business, you take out a loan. As the economy contracts, this is where things really start to fall apart. And this is why the Fed needs to add more money into the system. Because as the economy contracts and people start defaulting on their loans, they aren't able to pay off their loan obligations, they default. Borrowers and lenders take losses. And as they take losses, and as people are seeing their business not do as well, or as they're getting laid off, they all go to the banks and the financial institutions and they need to take out their money to pay for things like food and shelter and the things that they need to get by. But as I just said, the banks are taking losses as these borrowers are defaulting at the same time as people are coming to the banks to take out their money. How the banking system works, if you're not aware, is when you go to deposit, let's say $1,000 at the bank, they loan out basically all of that money. They typically only have to hold a very small portion of it with them. In some cases, they don't have to hold any of that money on hand. So you deposit $1,000, they loan that $1,000 out to someone else, then that person deposits their money into their bank, then their bank loans it out to someone else. So we get this money multiplier effect. And I actually think we should take a look at a little chart here. The first chart we're looking at is the base money supply. So we can think of the base money supply is the total amount of dollars out there. As you can see in this chart, the total base money supply is around $6 trillion. Now, if we go ahead and take a look at a second chart here, this shows the M2 money supply or the broad money supply, and it is around 21 or 22 trillion dollars. As you can see, the broad money supply is much larger than the base money supply. And that's because of this money multiplier effect. The money gets multiplied and there's so much credit out there for all of these base money dollars. So when I look at the money supply, I kind of think of the money supply as the base money because that's the true amount of dollars out there. But a lot of people use this broad money supply, this M2 measurement, to measure the money in the economy because it accounts for all the credit out there. And when we think about money, money is technically credit. If the broad money supply goes too much higher than the base money supply, this is when we start to get into problems. And as you can see from the charts, the broad money supply is almost 4 times higher than the base money. So in a situation like we were saying a moment ago, where the economy is contracting and loans are being defaulted upon, we can see this broad money supply really collapse. This is the reason that the Fed needs to continually add liquidity into the economy, because if we do get into a situation where the economy is contracting and everybody starts defaulting on their loans, then these financial institutions, the banks, take big losses on their loans that they don't get paid back for. At the same time, with the economy contracting, people are going to the banks to take out their money to pay for things like food and shelter, and the banks just don't have the money. And let's say people go to the bank to withdraw their money and they don't have it. Well, then people hear about it, everyone goes, and the bank fails. So every business that kept their money at that bank, every other financial institution that was working with that bank is in trouble. And this just kind of leads to a domino-like effect collapse. And this is the reason why in 2020, when COVID hit and things started to fall apart, we saw the government come in and shoot a ton of liquidity into the system because everything would have collapsed. We would have had a Great Depression-like event. In order for the Ponzi scheme to continue, the Fed must continually push liquidity into the system so that borrowers are able to make good on their investment and pay off their loans. So the credit-based system can continue to expand. But at a certain point, it will fall apart. Now, I want to go ahead and take a look at one last chart here, which is just the national debt. And as you can see, the national debt has continued to rise larger and larger. I wanted to pull a deficit chart, but unfortunately, the Federal Reserve Bank of St. Louis didn't have a very good deficit chart. They only had a monthly chart. I was looking for a yearly chart. But as you can see, this chart continues to slope higher as time goes on. And if we go ahead and take a look at that M2 money supply chart again, we could see that it looks very similar to the national debt chart. And that's because as we go into higher amounts of national debt, the money supply needs to increase so that the credit-based system doesn't fall apart. It needs more money to survive, and that is why inflation will continue to head higher no matter who wins this upcoming election. It doesn't matter, because we're at a point where the national debt cannot be paid back. Our interest on debt payments have grown too large. There's just no way. The government actually spends more on interest on debt now than they do on defense spending, which is pretty amazing. So this is why we have inflation. The national debt and the federal budget deficits are the driver. And at a certain point, people are going to wake up to the fact that this system fails in the long term. I'm a little surprised that more people haven't lost faith in the system yet with the inflation we've seen and this high amount of national debt. I think part of that's because the national debt, it does sound high. You hear $36 trillion, you're like, that's not good. But I feel like people don't have a clear understanding of its relation to inflation. As we see inflation get higher, more people are going to opt out of this system, and they are going to realize that this is just going to end with hyperinflation, and the government debt is going to be rising forever. It's like that friend that wants to keep borrowing money from you. At a certain point, you say, hey, I'm not loaning you any more money, even if you have a money printer. That is what is going to happen. We will see when that inflection point is, and that wraps it up for this video. Remember, the national debt is the driving force behind inflation. If you didn't like and subscribe, please make sure to do that now. Thanks for watching. I'll be back soon.